If you're retired or getting close, there's a tax clock ticking right now that most people still are not paying attention to. And it could cost some households tens of thousands of dollars over the next decade. Not because they made a bad investment, not because they retired at the wrong time, but because they missed a planning window. Here's the issue. For the last several years, Americans have been living under lower federal income tax rates created by the 2017 tax law. But as of early 2026, that lower rate environment is sitting on shaky ground. If Congress does not extend or replace those rules, many households could end up back in higher tax brackets than they've gotten used to. And for retirees, that is not just an accountant problem. That can become an income problem, a Medicare problem, and a legacy problem. Because retirement taxes don't hit in just one place. Let's say you built up a large traditional IRA or 401k. For years that sounded smart because you got the deduction up front, and for many people it was smart. But tax-deferred does not mean tax-free. It means postponed. So if future tax rates go up, or your required minimum distributions push more income onto your return later, the same retirement dollars you thought were efficient can suddenly become much more expensive to use. And this is where a lot of people get blindsided. They think, if my tax bracket goes up a little, I'll just pay a little more tax. But retirement tax planning is rarely that simple, because one extra dollar of IRA income can create a chain reaction. It can make more of your Social Security taxable. It can increase your Medicare Part B and Part D premiums through IRMA, and it can push surviving spouses into even tighter brackets later, after one Social Security check disappears and the joint filing status is gone. That is why this matters so much. The tax hit is often not one layer, it's 3 layers at once. Let's walk through a plain English example. Imagine a married couple in their early 60s. They've retired, but they have not started required minimum distributions yet. Their income is temporarily lower than it will be later. This is often the golden planning window. Why? Because once required minimum distributions begin, the IRS starts deciding how much taxable income has to come out of those accounts, whether you need it or not. And if tax rates are higher in the future than they are during this lower income window, waiting can be incredibly expensive. So the question becomes, would you rather choose when to pay taxes on your terms or be forced to pay them later on Washington's terms? This is exactly why Roth conversion conversations have become so important. A Roth conversion is not magic. It is not for everyone, and it absolutely needs to be coordinated carefully. But the basic idea is powerful. You voluntarily move some money from a traditional IRA into a Roth IRA. You pay tax on the amount converted now. And in exchange, future qualified growth and withdrawals can come out tax-free. So if you believe future tax rates may be higher, or that your own future income may be higher because of required minimum distributions, pensions, Social Security, or widow's tax status, then paying some tax in a known bracket today can be far better than paying more tax in an unknown bracket later. Think about it like this. Most retirees obsess over investment returns. But one of the best returns available in retirement may be reducing future tax drag. Because every dollar you keep from unnecessary taxation is a dollar that can keep compounding for you, support your lifestyle, or pass to your family more efficiently. And unlike the stock market, tax planning is one of the few areas where timing and structure can materially improve outcomes without requiring you to beat anything. Now let's talk about the current event piece. As of March 2026, the broad retirement planning concern is not that anyone knows exactly what Congress will do. The concern is uncertainty. That uncertainty matters, because once policy decisions are finalized, the best planning window may already be gone. You do not want to start thinking about tax flexibility after the brackets have changed, after required minimum distributions have started, and after Medicare surcharges have already been triggered. That is reactive planning. Smart retirees plan before the pressure shows up. And no, this does not mean everyone should rush into a massive conversion. That would be sloppy. Sometimes the right move is a partial Roth conversion. Sometimes it's spreading conversions across multiple years. Sometimes it's coordinating around Social Security timing. Sometimes it's using charitable giving, cash reserves, or other income sources to avoid stacking taxable income all in one year. The point is not to force one tactic. The point is to stop drifting, because drifting is what creates tax surprises. Here are the 4 questions every retiree or pre-retiree should be asking right now. Number 1. How much money do I have trapped in tax-deferred accounts? Number 2. What will my required minimum distributions likely look like later? Number 3. If tax rates rise or my filing status changes, what bracket could I realistically end up in? And number 4, do I still have a window right now to move money more strategically before those pressures hit? If you cannot answer those 4 questions clearly, that is the red flag. The biggest mistake we see is not bad intentions, it's delay. People assume they'll deal with taxes later, but later is exactly when flexibility disappears. Your best tax years in retirement are often the quiet years, the years before RMDs, the years before Medicare surcharges escalate, the years before a surviving spouse gets pushed into a smaller bracket structure, the years before Congress makes the decision for you. So if you're watching this in 2026, here's the message. Do not wait for certainty before you start planning. By the time the headlines feel certain, the opportunity may already be smaller. Review your bracket. Review your IRA balances. Review your future RMD exposure. And decide whether this is one of those rare moments where paying some tax now could save much more later. If you want help stress testing what a higher tax future could mean for your retirement, we offer a free 15-minute strategy session. No pressure, no obligation, just a clear look at where the tax risk may be hiding and what options you may have. The link is in the description. And if you want more plain English breakdowns of retirement tax traps, Roth conversion timing, and income strategy, subscribe. We break this down every week.